All right, so I wanted to do a midweek market report. And really what I want to do is kind of go over what we're actually seeing in the market because the market seems split right now. And there's a lot of reasons why, right? So really the market feels really strange right now. And I think what we're starting to realize is we're starting to see headlines saying that there's more sellers than buyers, rates are volatile, housing is slowing. And I've said this before and I'll say it again. I think a lot of that's a lot of doom and gloom. I think people are really concerned about things that they shouldn't be concerned about because remember what is driving most of these things is clicks. And what I mean by that is if you click on an article, it's because, oh my goodness, that is crazy. There is a singer for a band that was recently indicted for something that I'm not going to mention, but it's a band I listened to a lot as a kid. And this happened in the 70s, but it didn't give the whole story in the headline, which is interesting. But it's interesting to see how these things work. And it goes back to, I think, in my younger days when I was in my early 20s or late teens, I was a college student and I took a course in communications, media communications, and they talk about Nielsen ratings. And it's no different than today. Why? Well, you're going to rate something or grade something based off of the amount of views it gets. Likewise with social media, the amount of clicks it gets, right? So we know that these things are coming out. I personally don't share these things, even they come up on my feed. I don't like sharing them on any of my social platforms about how the market is doom and gloom because I don't necessarily think it is. And I think optimism will win in this market for most folks in most markets. Now, what I want to talk about in saying that is you read headlines saying that again there's more sellers and buyers, rates are volatile, housing is slowing, we're seeing, oh my gosh, this could be the Great Recession in 2008 part two. I mean, they've said that for the last 10 years, and what's happened since then? Homes have continued to appreciate. We saw a little dip here and there, but when you look at the grand scheme, which is really your 90 to 180 day plan, so every 3 to 6 months, look at the larger scope, not what's happening that month. You get slower months, you get busier months. So, yes, let's go through what we're seeing with economy and rates. Right now, we see the market that's reacting heavily to inflation concerns because of oil prices and everything that's happening globally. Oil moved higher again after more tensions overseas, which pushed rates a little bit higher, not back to 7.5. Again, inflation's not at 9.2 as it was in 2022. And remember, right here, what's important to think about is whenever oil spikes, inflation concerns rise with it, right? And mortgage rates tend to react negatively. And the reason why I say that is that's what we see in these markets. Keep in mind, inflation is the arch enemy of mortgage rates. And at the same time, we see job data. It's getting interesting. On paper, employment still looks fine and dandy, looks okay. But most of the job growth is coming from healthcare and education, with a lot of what's in the private economy or private sector, if you will, feels a little bit slower. And as I say that, we're looking at larger companies that yes are publicly traded. If you look at Meta, if you look at Tesla, if you look at Amazon, and the Bay Area has had quite a few layoffs. So we're running into more conversations about AI impacting jobs, especially in the tech industries. And the reason why I mentioned job numbers, and this is so important to remember, job numbers can, of course, affect what we see in the market. If we see higher unemployment, we'll see interest rates dip a little bit lower. You'll see the bond markets react. Of course, mortgage rates are based off of bond markets and mortgage-backed security, which is a bond, and you'll start to see those things react. So what we're actually seeing is, this where it's getting interesting, by the way, despite all of that, we're still seeing strong activity on good homes. I'm talking multiple offers, competitive situation, and solid buyer traffic. And honestly, it feels like the market's split. So the good homes that are priced right and show well are moving. They're selling. There's multiple offers. The overpriced homes are homes that miss the mark or sitting longer. And so this goes to say that both things can be true at the same time. And I want to bring up two examples, actually three. We had a property that my buyers loved. They made an offer on it, and it was a cash offer that won over our buyer's offer. There's 15 separate offers on that property, and our buyer didn't get it, despite the fact that we wrote a 10-day close of escrow. They're fully underwritten. We really just need title, an appraisal to secure the insurance and move thereafter. And the cash buyer won, they won 100,000 or so above our offer price or what our buyers offered. The second example, it goes to multiple offer situation. I know of a listing in Oakland that listed at 800,000. That's more than likely in contract now for 1.2 or 1.3. And in Oakland, California, they had a line at their open house that was literally a block long of buyers waiting to tour this property over the weekend. An agent partner I work with, someone who's a dear friend of mine, was sharing that story with me. I'm like, my goodness, that's incredible. She's like, yeah, well, that's how it is. They'll price it lower, especially we see this in Oakland, Alameda, and Berkeley, in that little Tri-City area there in Alameda County, California, where they'll price it lower knowing that it's going to go for much higher. And you have to be competitive. If you're a lender out here, we've been doing the 14-day close for, gosh, I think 10 years now. It's something we have to do really every single time, no matter what. Get them fully underwritten so they can make those competitive offers to win. Now, here's another scenario. A VA home loan buyer looking to purchase property in Novato, California, which is Marin County, beautiful property, needs a little work, candidly. So, it may be a difficult VA situation. However, there's not infestation. I'll kind of put this footnote here. It's called NPMA 33. If there's no active infestation on that report, it generally clears the report that's needed for a VA home loan in most cases, unless, of course, if the appraiser calls something out or something that comes up new as the home is being inspected. That's kind of what we're dealing with. But this property is listed for 100 days. It's been sitting. Why? Well, it's all about location, where it's priced, and the fact that it may not be moving right away. So let's talk about San Francisco, as we mentioned earlier. So one thing that's super interesting about the city, or San Francisco, where I'm from, a lot of people wrote off San Francisco real estate recently, especially condos, right? Everybody's moving out. 6 years ago, COVID, people wanted larger space, larger rooms, work at home. Well, now people are going back to work. Now we're seeing AI money come into San Francisco, right? So now we're seeing more movement there again. We're seeing a lot of cash buyers. We see tech liquidity. And of course, some of it being AI related wealth starting to flow back in the market. Again, we're seeing 15 to 20 offers on properties in San Francisco. It doesn't sound like a slow market. It doesn't sound like doom and gloom, like those clicks that you see on Instagram, right? Or those posts that make you click, that look, and like, oh my gosh, 2008, there might be an opportunity. Now, I'm not saying there's not opportunities out there, but it's just important to understand your market area. So the buyers that are getting deals done are not necessarily waiting for the perfect market. I actually had a call with a client who's looking to purchase in Sonoma County, and we went over the cost of waiting. We used an average conservative appreciation figure, what we're currently seeing in Petaluma, California, and it's 6.11%. So if they're looking to purchase a property for 900,000, we went over, hey, if they were to wait 6 months, they'd miss out on $50,000 worth of equity. If they waited a year, they'd be missing out on over $100,000 of equity. So remember, the cost of waiting is a thing here. And if you ever want to do one of those calls, or if you even want to do a podcast with me and you're a client or a buyer or an even agent want to kind of work through that, I love to share what that tool does, because it really does help open some eyes. Again, interest rates are not 7.5 as they were, a few years ago. They're lower than they were. They're 6 to 6.5, depending on what's happening in the market. A lot of it, of course, based off of what I mentioned earlier with global conflict and things we're seeing globally with Iran, oil prices, what have you. But what we are seeing is buyers still making offers. We're seeing buyers come into the marketplace. We're seeing 5 times as many buyers come into this market, in fact, in the last week, based off of Case-Shiller, than we have last year. So we're seeing year over year more buyers. Another thing we're looking at is, of course, yeah, there are more properties in the market. People are like, oh, what's going on? There's more properties in the market. Well, this is seasonal. And candidly, it's seasonal. If days on market is prolonged, I will tell you there's opportunity there for sure. If you're a buyer, you're like, you know what, this market's been sitting forever. It's listed at this. Maybe talk to your agent if you want a good agent. We know quite a few. We would love to connect you. Just visit the link in the bio, but maybe think about making that offer and seeing if the seller is willing to work with you on what that price actually is. Right. But we are seeing more properties on the market this time of year. Yes, of course, those are other headlines that we're seeing. It is spring. You tend to see that in spring. You see that into the summer months, right? And that's that time of year that we tend to see more properties listed. So we're seeing also now on those properties, as I mentioned, with more days on market, not only maybe a reduction in price if the sellers were willing to work with the buyer, but seller paid buy downs. We're seeing seller paid closing costs. We see buyers now looking at adjust rate mortgage products or looking at the refinance planning. As I mentioned, if you have that cost of waiting, you miss out on equity. Keep in mind, interest rates do dip. And I know there's that whole thing, and I mentioned this before. I'm not a fan of the saying, marry the house, stay at the rate, right? I don't like that idea, but I do think that rates will dip again. They'll come back a little bit. They already did. They did, 6 times in the last 2 years. You just have to be ready for it. And we have a whole strike rate program that's set up specifically for that. For when rates actually improve, we could take advantage of that for our clients, and they know that, right? And we offer credits for those that do that and purchase a home now and wait 6 months or so and wait for that opportunity. Another thing we're seeing and a lot of questions we have is DSCR home loans. In fact, I posted another social media forum today about how DSCR home loans work. It's a great investor tool for investors. If you're looking to purchase property, putting 20% down or more, really, and there's rental income that we're qualifying that. Again, it has to be an investment property, but we're qualifying that purchase of that property based off of the rental income, right? And they're great price transactions. Believe it or not, they're pricing right alongside what a conventional mortgage with more documentation would price. Because, of course, a couple of years ago, we have something called loan level price adjustments or risk assessments that were heightened in order to create more funding or availability for buyers looking to purchase their first home, per se. And it was something that was in May of, I want to say, 2023. So keep in mind, long story short, not to ramble, people are simply adjusting instead of sitting frozen. So really, my biggest takeaway to this is the market isn't dead, it's selective. And I think that the people who understand strategy over headlines are the ones that are going to win over the next 12 months. So just a quick share, a quick market check-in, if you will, on what we're seeing right now in real life. And so if you ever want to talk strategy, scenarios, or just compare notes on the market, feel free to reach out. And if you want to jump on a podcast with me, if you're in our industry or if you're a buyer with questions, please shoot me a message. I would love to have you. Really just thankful for the opportunity of sharing this news with you. And of course, you listen in, blessed by you. Feel free to share this with anybody that you think may be of interest or interested in this material. And have a blessed day.